The stock market's been doing phenomenal, really, in 2023 specifically, right? Dow's held up very well, done actually pretty good this year. S&P 500's done well. I mean, if you could get the gains S&P 500's had this year, you'd take those every year, right? NASDAQ's done obviously phenomenal this year. And what the stock market is basically a confidence gauge for everybody in general, right? And if we have any actual weakness in the actual stock market, you're going to lead, especially when it comes to S&P 500 specifically, right? Because so many people are in S&P 500 index funds, something that mirrors that. Then the confidence goes down, right? As soon as people's 401ks start going down and retirement accounts, because remember, most people are not like you watching this video 20 minutes in, okay? And you care a lot about the markets and stocks and your portfolio and all this stuff. Most people are not like you watching this video right now. You're like the 1% of the 1%, okay? Cool, I appreciate you, okay? You're like me. But I'm telling you, most people are not like that. Most people don't look at any of this stuff most of the time until every once in a while they open up and they see what their 401k's at, their retirement account. And if suddenly their retirement account says $80,000 instead of $105,000, they start saying, what the hell's going on with the stock market? What's going on? Is the economy about to get bad? And that kind of starts to have a little bit of a panic in itself, and people start pulling back more and more, right? We saw a little bit of that in 2022, but not to as big of an extent as you might have thought, right? Because of how kind of quickly the market came back there, and S&P 500 didn't get hit nearly as hard as the NASDAQ. If the S&P 500 gets hit hard, believe me, people will wake up quick. And next thing you know, everybody's going to start paying attention really quickly, okay? And all of a sudden, mainstream media starts picking up on it. It becomes a big news story. It becomes trending, all those sorts of things, okay? So we'll see how all that shakes out. But I'm just telling you, like, this is a big confidence scorecard, okay? And if that gets hit, then confidence in general is going to get hit quite significantly, right? Now, we also have an interesting phenomenon that's going on, which is, I'm sure you guys have seen some of these deals recently, the UPS deal. You got, obviously, the United Auto Workers deal that's potentially going through. The United Auto Workers president just today called GM's offer insulting ahead of a strike deadline that's a week away. So we're in an interesting situation where workers are demanding, obviously, wage increases, and quite substantial wage increases, not like 1%, 2%, 3%. We're talking about big wage increases. But companies are now starting to have trouble offsetting the increase of wages to the consumer because the consumer is being hit really hard, right? So that's where you get into this potential of stagflation, which no one really wants to see, but there's an argument being made that maybe we're starting to slip into stagflation, from inflation to stagflation. U.S. stagflation risks rise as service sector falters alongside manufacturing downturn. Growth of business activity in the United States came close to stalling in August, according to the final reading of S&P Global's U.S. PMI. Looking at the broad split of data, manufacturing output slipped back into decline after a brief resumption of growth in July, right? Now, if you watch Mav and never hear his opinions, Mav's been calling for stagflation for quite some time, right? And he's one of those folks that definitely sees stagflation coming. Stagflation is not a good situation, folks. That's a situation where we have a weak economy, high prices, and that leads to, ultimately, job losses. Because eventually, companies are just getting slaughtered, and they have to start cutting jobs. And we're talking, not just talking about like the tech companies that were cutting jobs last year, we're talking about the mass, okay? The massive amount have to start cutting jobs. And they're like, dude, we can't afford to pay all these workers. They want all these wage increases. We can't afford this. The consumer's not out here buying what we're trying to sell anymore because they've been hit so hard by inflation, and you run into stagflation. It's not a pretty situation. It's a very ugly situation. It's something obviously the Federal Reserve doesn't want to see. But nonetheless, you can make an argument that we could be slipping into stagflation recently or very soon here, and that's not a good situation. Meta. So Meta, we're up about 145% on this one, up $325,000. And this is the biggest position in the portfolio, even bigger than good old Tesla. So this is $548,000 position versus $419,000 position for Tesla. Now, in regards to Meta, okay, is Meta stock a buy? Okay. Yes, absolutely, Meta stock's a buy. Here's what's going on with Meta stock. Now, am I personally going to be buying it? Probably not, because it is already such a large position. I'm already so overweight Meta. That's a problem with me in Meta and Tesla, to be honest. I'm overweight these stocks heavily right now. 31% of my portfolio is in Meta, 24% is in Tesla. Now, do keep in mind, it's not like I put 31% of my portfolio in Meta and 24% Tesla. The stocks have gone up so damn much that they became such heavy weights in the portfolio, right? I'm up $380,000. Like my cost base is like $23,000 or $39,000. I mean, excuse me, is like $39,000 in regards to Tesla, right? So yeah, cost base is $39,000 and we're up $380,000. And when it comes to Meta, cost base is a little over $200 and we're up over $300 on the stock. That's how those became such large positions. So I can't really add Meta, but the stock is still a buy, actually, and I understand it's had a great year. It's irrelevant. Whatever's happened in the past year for the stock price is irrelevant. The bottom line is with Meta, it's trading at 22 times this year's expected numbers, right, 2023. And we're talking about one of the best balance sheet companies in the world. We're talking about Zuckerberg that's got the team very focused. They're going to run lean and mean for the next several years. And we're talking about when you own FB Messenger, IG, and WhatsApp, you got a very bright future in front of yourself, right? Plus the metaverse opportunity. I'm really excited about, Oculus 3 and, MetaQuest 3, whatever we want to call it, and whatever that produces for numbers. I'm looking forward to getting my hands on that and trying out that product. I think it has huge potential. So when it comes to Meta, the stock is still a buy. I won't be buying it. Hard decision, but it's 31% of my portfolio. So I've got to watch, because at the end of the day, you never know what could happen, right? And you've got to watch your risk levels when a position's already too big in your portfolio overall. So yeah, Meta, love that one. Individuals got hit very hard, obviously, from inflation. Let's not sugarcoat that. That was 18 months, if not 24 months, of just inflationary pain in a substantial way, right? And so now we're at this moment in time where hopefully the consumer can get in a much better place over this next 12 months than they certainly were in the last 12 months. Now, in order to have that happen, you need inflation to stop being a problem child, right? And you need people to be able to keep their jobs and hopefully make at least as much from their jobs, if not more from their jobs. If you don't have that, then you have a stagflation situation. That could be very ugly for the market to deal with in 2024, okay? So let's be very clear about that. So the retail wreck has been going on for minimum a year, but if not almost 2 years now at this point in time. I mean, retail as a whole peaked in kind of the end of 2020 into the beginning of 2021. And basically ever since that, let's call it just first half of 2021, ever since then, retailers have just been kind of slowly drifting down and things have just gotten slowly more disappointing, right? Now, there's two sides you can take on that. One side is it's just going to keep getting worse and worse and worse. The other side is we're in a kind of a trough area. You're in kind of that blow-off bottom phase. They call it a blow-off top phase when there's just everything's great news. Stock reaches an all-time high or a new 52-week high or something like that, and everybody's just so excited, right? You also have kind of a blow-off bottom when it just seems like everything is bad. The earnings are bad. The company guidance is bad. The company commentary is bad. The sector's bad. It's just like the whole depressing situation for that industry sector to go through at that particular time, right? Certainly we went through that on a lot of tech stocks in the fourth quarter of 2022. That was the blow-off bottom there, right? And I feel like for a lot of these retailers, we're going through that phase. We have been over the last couple of months, and we're probably going to over this next couple of months of just kind of this blow-off bottom where it's just like everybody's doomsday. And that's usually when you see the bottom, when it's just that overwhelming capitulation to just, I don't care what I sell this stock at. I will sell it at any price. We just watched it happen in the most famous companies in the world last year. Somebody sold Meta shares at $88. $88. Somebody was selling NVIDIA at $110. Somebody was selling AMD at $55. Somebody was selling, what other stocks? Netflix at $175. Like, come on, man. When everybody wants out of something, they all pile to the exit at the same time.